Welcome to Life Planning 101, brought to you by Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
All right, good morning. We have another episode of Black and White Market Chatter right here on Life Planning 101. Myself, Matt Ervin, and Aaron Kennedy here with you this morning. Forgive me for my Darth Vader voice. Aaron's been teasing me all morning about it, but we want to try to get a show out and put everybody's mind at ease. So really our theme of this morning is we need to stay invested. So I'm going to let Aaron kick it off and talk to him about all the calls we've had lately.
Yeah, this has been a pretty amazing time. Started getting phone calls at the beginning of this month, and there's a little bit of market volatility. I believe the market was down about 4.5%, and people are worried about that. And a 4.5% drawdown is, I don't want to say it's nothing, it is. It's a movement, but it's an average movement. It's not really anything to be concerned about. Happens several times every single year, and it's just a normal market volatility. But what was different was the amount of calls I received. Even during COVID, from February to March, I bet we got 2 phone calls or 3 phone calls. And most of the people that were calling were, hey, I can send you some money. Right. This is crazy. I want to buy some of this.
How do I invest?
Right. So 4.5, people are scared with that. It's a different world we live in. And people are in a different mindset than what they were almost a year ago.
Right. So they've been used to seeing their statements go straight up every quarter. So it's kind of back like, what was it, 2016? We saw the market go up and up and up. And then, I can't remember. It was January to February, I believe. Maybe it was even like 2019. January was up 4, February was down 4. We got some calls then too. So it really felt familiar to us that, familiarity bias, right? Recency bias. We get used to seeing the green numbers.
Yes.
and want more of it. So,
and I think what is more fascinating is people's optimism today versus the beginning of 2020, and it is a completely different mindset. And you really can't blame anybody because it's something that we're being forced to face almost every day. Bad news every day. And I believe people are starting to think, this has got to capitulate. Something's got to come out. And can I be the first one out before things get really bad? But that's the feeling. I wouldn't want to be in that spot. No matter what the news is right now, I think being invested is the way to go. And I really don't think the risks are as heavily today as what we feel normally. At the top of a bull market, nobody's scared. Nobody's scared.
Everybody wants more. The greed's there.
If the market drops 4.5, FOMO takes over. You've probably heard FOMO, but if you don't know what that means, it's fear of missing out. Buying a dip, trying to pick up things before they go hyperbolic up. And it's not the case. People are terrified. Right. So that's a good thing.
Yeah, and it's interesting to kind of think about let's think about a risk-off asset just for 1 minute. Bonds. Bond yields have been going, down for how long, right? 15, 20 years or longer?
Since the 80s.
Since the 80s. Okay, so longer. So it used to be that you'd buy a bond and your price would appreciate and you'd continue to clip those coupons. Well, now, with rising interest rates, you think about, price down, yield up, or vice versa, your bond price is going to depreciate and you're clipping coupons that are a fraction of what they even were 10 years ago.
Right. Yeah, we're looking at about a 1.5, 1.6 on the 10-year.
Mm-hmm.
Since yields are this low, when we're modeling out our portfolio, we model out the bond position as a zero return.
You have to.
Zero return, because there's just nothing that's going to be there. And the yields are so low, and we're in this point of fear of inflation. What the Fed's going to do to fight that? Are they going to raise interest rates? So it's actually turned into quite a volatile asset class here very recently. And that's spooky because that's where we're supposed to be going to get our risks down. And it's really probably one of the riskiest points of the market right now for what it's supposed to be.
Oh, when you look at yield movement, it's been down at as low as 1.34 from 1.6, and now it's back up to 1.6.
Right.
When you're talking about numbers that small, it's like, oh, it's only 0.3. But when you throw 0.3 over 1.6,
It's a big move.
It's a much bigger percentage, you know. And you think about that, and the fear is there for people because, you know, we've met with folks that want to pay cash for everything, and, you know, cash is king. We know that. And, you know, it's challenging to think, why would I not want to pay, you know, these low interest rate? I mean, cars are financing at 0 or just above that. You know, houses have gone up a little bit, but have been over the last 12 months very low as far as interest rates. People are still wanting to pay cash, and people are wanting to pay a 15% income tax rate to pull out of their IRA versus paying a 3% loan rate, because then it's paid off. But why? It's the fear.
It's
right?
the fear. And that's one of the risks you should actually be taking right now. I mean, big picture, the value of the dollar is going down. It is going down at an alarmingly fast pace. You know, we're not picking it up in the markets, but we are seeing it in our inflation numbers. If you add in housing, if you add in your vehicle, if you add in food, you know, inflation is hovering around 18% right now. So your cash is hurting you. You know, so how do you combat that? Is you use somebody else's cash.
That's right.
And you buy something that's not cash.
We like that, Aaron. We're going to pick that right back up here in just a moment. I have to take a quick break here on Black and White Market Chatter on Life Planning 101. We'll be right back with you. And here we go again with Black and White Market Chatter right here on Life Planning 101. Matt Ervin, Aaron Kennedy with Kennedy Financial Services. Aaron, you were talking about why cash can hurt you.
Yes. In high inflationary periods, you know, our purchasing power is probably the most important thing that we need to be paying attention to. And to take one step back, you know, recently, taking very little risk in a portfolio has been the most difficult area to invest in. You know, people that want to reduce the risk, reduce the volatility, we're having to go into instruments like treasuries that are just not paying anything. You know, we're back to the 1.6%. So if you're only making 1.6% on a 10-year note, and we can expect inflation to be, you know, what if it stays at 18% for 3 years? That's half your money's gone. That's half the amount of gas you can buy, half the loaves of bread, you know. So the bad thing is there's not a hope that we can make that return back in those low interest rates environments. So we have to take risk to even keep up with the game. And anytime you say risk, it's scary. Right? But we just got to wrap our mind around taking different kinds of risks. So one of the greatest things that we can do is use other people's money. If we can take out a loan and buy something that's going to appreciate, whoever loaned us that money has that risk. You know, we're going to be paying them back in dollars that are worth half as much 5 years from now. You know, so in all actuality, the thing that you should be doing is borrowing money and then buying an appreciating asset. No different than someone buying their home. You know, I'm not saying go out and buy a home right now, but that should be the idea. And that is a risk. It's a real risk, but that is one that everybody can understand and have been through there. And, you know, guess what? The rest of the world is feeling the same way. Look at all the houses that are being bought right now. You know, look at the value of your home. If you want to buy one, you got to go bid 20% higher than what it's worth. You know, it's what we should be doing, is using other people's money, using other people's cash, because that is the asset that is depreciating the fastest.
Right. So when we think about that, you know, that's there's a risk to that, but there's also risk of being too safe. So we talked earlier about, I want to dive into this idea of permanent versus temporary loss of capital, right? And when you talk about the risk of buying the treasury and holding the treasury and buying something that can't recover. If I buy a treasury today, I'm permanently accepting the fact that I'm going to buy a third less goods shortly into the future, right?
Yes.
Versus if I buy an equity, that equities, real estate, there's those asset classes that are designed to keep up with inflation historically in the long term.
Right.
Okay. So if I buy an equity and it goes down and then recovers, that's a temporary loss of capital.
Yeah, market volatility.
So kind of expand on that, temporary versus that permanent, and then to dive back into that.
Okay. If we're buying in equities, saw the numbers right now, the average yearly volatility of the stock market right now is somewhere around 20. We can expect the market to be up 20% or down 20% in any given year. But over the long term, the market should still average 10% even with those drawdowns. And the market's been on a tear here recently. The averages have been a whole lot higher than 10%. But we have that hope of the recovery. We're going to return to the averages. So that's the hope. But if we are low risk investors, if we are only buying treasuries, there's very little hope of clipping that 1.6% coupon and making the money back that we've lost to inflation. And think about this. I heard this the other day, and I loved it. What he was saying is the printing of money is nothing but a hidden government tax. It's a tax on your cash.
Wow. Yeah, so that's, you see that when they say this new bill is going to be zero cost, right?
Mm-hmm.
But it's not true. And we see that because, the thing that's challenging, I know it's getting a little off topic, but the thing that's challenging is we've talked in the past about financing that payment. Okay, so the government's financing a payment. And there's something like 4 to 5 of the Fed chairs that are up for change, right?
Yes.
Forgive me, I don't know the exact process, but nonetheless, what we're hearing a lot about is it's very difficult to project the slowing of the buybacks of the bonds,
Yes.
and very difficult to project the interest rate hikes, because the people that we've been listening to for the last 12, 24 months may be different in the next 6 months. So super challenging in regards to making forward plans. So we go back to, you take the people out of the equation, you go back to the basics, right? Typically, government has caused most market corrections. Would you say that's fair to say?
Yeah.
In some regard.
I don't think there's such thing as a recession without government.
Government's help. That's good. Okay.
There's never been one. Because humans are pretty smart, Just think about even back when we were cavemen. If we've eaten all the berries off the blackberry bush, we move over to the apple tree, And then once that runs over, we go somewhere else. But what happens if the government comes in and taxes all the apples?
We'll find something else.
We find something else, and then they tax that. And now that government intervention has actually hurt the economy when they were trying to do good. So ever since the beginning of the time, almost all recessions have been caused by government intervention, one way or the other.
Well, thank you to them. So let's take another quick break, and we'll wrap up here in just a second. So right here on Black and White Market Chatter on Life Planning 101. And here we go for the final segment of today's episode of Black and White Market Chatter on Life Planning 101. Finishing up our gratefulness to the government for causing recessions, and kind of diving into really, we're solution driven, right? We know this. We've set a stage to understand some of the why we need to stay invested. So let's talk about that in more detail. So we went over the permanent versus temporary loss of capital, but none of this equates to none of it deviates from the true process of getting our risk right.
Yes, got to get that risk right. We're in a challenging area right now. A lot of equities are priced at all-time highs, so things are very, very expensive. And they're also they're even more expensive with the fear of interest rates going up. So all these growth stocks are going to be, they're not near as enticing if we think interest rates are going to go up. What we need to be doing is taking the right kinds of risks. And a lot of the things we've already talked about. If we know input prices are going to be going up, we probably need to be buying some of those inputs, such as commodities. We need to be buying companies that can actually accelerate in times of high interest rates or high inflation. Somebody's going to be making that money off of high prices, and why can't it be you? But it's a different mindset. We've absolutely been spoiled lately as the market only goes up, volatility only goes down, and that's just not the case right now. There's too many moving parts that are acting against us. So when you're looking at your portfolio, I think for at least the near future, we need to be more acceptive of higher volatility. And we don't have to do it with all of your portfolio. That's the trick of getting everything right, is what is your risk number? And we can invest to that risk number. But if we give up, now we're looking at 18% purchasing power with a 1% coupon. That's painful, especially for retirees, that are living on a fixed income. Inflation is nothing but a tax on fixed income. That's it. So how do we position your portfolio to act differently? How do we position your portfolio so you can take advantage of what's going on and not be a victim?
Right. And there's lots of tools out there, right? That's why, the beauty of what we do is we're not restricted,
No,
right?
we're
We
not.
talked this morning about commodity funds that have the momentum overlay
Yeah,
that track whatever commodity is being bullish,
right.
right? Something interesting I heard even just this morning, there was a gal on that was looking at call demand versus put demand, meaning do they want more insurance, is the puts, or are they more bullish versus calls? So if there's more demand for calls and puts, that means there's a sentiment in the market that we're going to have growth,
Yes.
right? So there's lots of things to get behind. I know it's scary when we see something we've never seen before, or when we see something we've not seen in 18 months.
Right. And we remember what happened last time.
Right. And it's always going to be as bad as it was when it was real bad, and it's never going to be as good as it is, right? So we're victims of our own minds, if you will. But
Recency bias, even if it was not so recent ago.
right. And so we have to frame this a different way to really think about, risk off is not just bonds anymore. That develops a whole new risk, right? So we were talking this morning, it was kind of funny. We're trying to say, how can we illustrate this? And it's like, okay, I used to be able to drive 35 or 40 and pass the dude on the bicycle. Dude on the bicycle is inflation. Now I'm driving 35 or 40, and that guy's smoking me. Downhill, he got his head down. I don't know what kind of grease he's got in his bearings, but he's rolling by. And I need to catch up, at least stick with him, right? Because I don't want to take that permanent loss of capital and say, I'm only going to buy a half a gallon of milk next time. And then I'm only going to buy, a little quart jar. And all of a sudden, I'm lucky to get 3 drops, right? We got to stay up with inflation at least. Doesn't mean we have to be overly aggressive, but there's a lot of good things happening, and companies, their own self, are taking advantage of that cheap capital. Hertz, this morning, buying 100 million Teslas? It's like a several billion-dollar contract. Nonetheless, they're taking advantage of cheap money. They're investing in their future, right?
Yeah, this goes back to what we were saying earlier. Someone's making money out there,
Right.
and we need to find them. If you give up and get on the sidelines, that bicycle's way past you, and
Yeah.
you're not even going to be able to catch up.
That's right.
I love the bicycle because I used to ride quite a bit, and there's a gigantic hill pretty close to our house. And we could easily get up to 45, 50 miles an hour without trying. And if you've been on a road bike, those things get kind of shaky at those speeds.
Yeah.
So
for four wheels at that speed, thank you.
Yes. So I love that example.
But it's good. And so what we wanted to paint today was there's options, folks. There's options out there that we can keep you comfortable with your risk, because that's the most important thing. You have to sleep at night.
Got to sleep at night.
That's number one.
And we preach this risk score so much, but it is absolutely so important. We got a lot of things that we can do to get through this period of time. And then when we're looking back 10, 15 years from now, we're going to say, hey, this was no different than any other time.
Right.
We were able to manage it just fine. But we may have to look at things a little bit differently.
I'll tell you what, Aaron, I hate to wrap it up, but we're going to have a part 2 to this and get some exclusivity on our website. So look for that later towards the end of this week. We're going to put out the part 2 with more solution-oriented podcast. But thank you, folks, for being with us today on Black and White Market Chatter right here on Life Planning 101. Matt Ervin and Aaron Kennedy.
Everybody have a great week. Can't wait to see everybody. It's been too long. Just God bless everyone and be safe.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.